Okay, so this is day number 10 of the one contract MES evaluation challenge. I didn't trade on Wednesday, the 1st of May, and the reason being is because it was FOMC day. And if you are a new trader, you should most definitely not trade FOMC days. And I'm going to show you why, okay? So this was the build up. You can see it's very rangy, it's very choppy. So then the data drops and we get a spike up, and you can see here that from when Powell started to speak, we had candle ranges from 77 to 53. So like 20-point candles, and you simply cannot just trade this and have a good stop loss because it just would not work. And you can see he's talking, conference finishes, and then the market dumps right back to where we started. So this was not an easy day to trade, and which is why I would not recommend that you trade FOMC day at all. Okay, there's plenty of opportunities. FOMC day is once every few months, and it's just one day out of your trading calendar that you should mark off and have a day off. Anyway, so post that on Thursday, the market started to rally overnight. And we had these lows and we had this high from FOMC and obviously the main high at the top of the channel. So when market opened, if you look on the 1 hour, my outlook was bullish. You can see here that we've been creating higher lows. So my thesis and my thinking at the time is today, after FOMC day, we are still in pretty bullish. I'm going to take calls. So the market opened up. Now before market opened, right here, we had our highs and our liquidity levels marked. But just before market opened, you can see that at 7 o'clock, we had rejected this liquidity level. We rejected it again. And then right before market opened, we rejected it for a third time. So if you had seen this, you could have created a very, very strong order block, bearish order block right here off this green candle. So market opens up, rejects it again, and then we start to dump. Okay. Now, while we are above the 200-day moving average, I'm only looking for calls. I want the liquidity levels to be hit, this to come down here, and then buy the dips. When we are below the 200, that is a bearish indicator. What I'm looking to do is take puts at the best risk to reward. Probably all the pop-ups I'd probably sell. So when this started to dump now yesterday, as soon as the 200 went, I decided we've got a liquidity level below here. That starts, if that goes, I might think about taking puts. So first this liquidity level went, and then this liquidity level here started to hold. So I was like, hold on, I better not take any puts. So then this level went as well, and we had a pullback right here on this green. Now this gives me more of a reason to enter. Okay, the reason why is because I can draw an order block here, and if this breaks, I'm entering, and my stop loss can be just above, and then my target would be the next liquidity level, and the next liquidity level was the bottom of the FOMC sell-off or the complete low of Wednesday. So I entered right here in this area. As soon as this green candle, we got below this green candle, and I targeted here. I was going to exit here, however, the candle just broke straight through and when we started to wick at the level is when I closed. So that was the first trade of the day. The second trade of the day, now this was Wednesday's low, okay? And you can see straight away that we rejected it and buyer stepped in with volume. Now, ideally what we want is we want an order block here to turn into a breaker to go long. We didn't get it, but I took a position right here, 5053. And that was just because the liquidity got flushed at such a high volume green candle. Now, to be safe, what you want to do is you need this order block to turn into a breaker, and you can see we're going up. It's getting rejected. You got the 200-day moving average there as well. So you don't really want to take a call right close to it. You want to take it once it's gone. But eventually, this order block turns into a breaker right here and here. And once you get above the 200, you can still catch this play, and you would have got from 70 to, you would have got a nice 42 point move. Okay? But this is how you avoid all of this area here. When you start seeing the pullback and you start seeing the chop, you only want to take calls above the 200. And if the 200 starts to reject, then you want to take puts below this order block. So those were my two trades for yesterday. I'm going to just check one thing to see if we would have got an order block earlier on the 2 minute. And yeah, this was, so here would have been, let's see if this would have held. So there would have been an order block right there on the 2 minute. After the liquidity got swept, there's an order block that came down. Now when that turns into a breaker from here, or it starts to hold here, you can take a position. It would have been a lot earlier, but you have to be wary of the 200. This would have given you a tighter stop loss. So there's the order block you want the market to come up. Your stop loss is right below, so it'd be around 446, a close below the order block, and you could have held this from 446 all the way to high of day of 510. So you would have got a 60 point move. But the safer bet would be to take the position on calls above 200. And every time the 200 rejects, you can take puts, and you would have caught some nice plays. So this here, 70 down to 54. This would have been 70 down to 55. So while you are underneath the 200, it's definitely you're looking for puts. But where we are so far away and the liquidity's been swept, you can take calls. But ideally, what would have been a good play is that a fair value gap would have appeared on this candle here, and then you come down and take it. But those were my trades for yesterday. Great day, very close to completing this evaluation, and I'll see you closer to opening bell.